Hey everyone, and welcome back to another video for today. So people are freaking out because SoFi is only up 84.5% year to date. But because the stock is now down 5.4% on Tuesday and it has seen a small 12% pullback since the recent peak here mid-September, people are already freaking out. Is this normal? No, this is not normal. This is sometimes even greedy. Right? You can go up 100% or so, and then yes, you will have some small pullbacks. Now, yes, more recently, there was a reason why there was a pullback in SoFi stock. Is it something you should be worried about, or is this just noise? That's what we're going to talk about in today's video. So, what was the reason for the small pullback more recently? Well, it had more to do with another company that is inferior to SoFi, a company called Upstart. And as you can clearly see, Upstart of the last 5 years, not the greatest performance. Year to date, it's actually down 15.6%. And over the past year, it is up 28.3%. It's a company worth $5 billion. It is a cloud-based AI lending platform. Some people have asked me to cover Upstart. I always say, why should you buy Upstart when you can buy SoFi? Because SoFi basically has an Upstart in their business. When we talk about the loan platform business, I think for SoFi, it is just the better choice out there. Now, what has happened with Upstart? Well, we had a note from BTIG on Upstart. So August data from Upstart's ABS, which is asset-backed security securitizations, shows accelerating delinquencies in both the month of July and August. We are candidly surprised by the rapid increase. August over 30-day delinquencies across the trust now exceed 11.2%, up from 10.4% in July, both of which are well above the 6 to 8% range that delinquencies have ranged at between October 2022 to May 2025. That caused Upstart to drop quite significantly. And I mean, Upstart's crash in stock price already started back in August. It peaked here at $87 or so, and now it's down around 40% since. More recently, we've seen the stock mid-September go from $71 to now around $50. That's down 28%. Now we have even more information by BTIG. Before jumping into that, if you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, they're addressing here the questions on August securitization data deterioration, not just in Upstarts or autos. Cross-asset class and seasoned vintage worsening implies consumer, not specific company, underwriting. So what you should know, we don't have here the whole report, so apologies for that, but these things usually aren't publicly available, so we'll take whatever we can get. There's been a significant investor interest in our August monthly data reports on the auto lenders and on Upstart. In this note, we wanted to publish additional commentary on our views of consumer finance. We also want to clarify what concerns us when we are looking at vintage curves in the August monthly data. When we look at monthly delinquency curves, we are looking at both the height and the slope of the curve relative to other vintages, and also what is considered a normal delinquency curve. In Exhibit 1 on the next page, unfortunately we do not have that, they use Carvana, which they have a buy rating and a $450 price target, as an example of an expected normal curve. Okay, again, we don't have it, so we'll move on. Carvana's curve is normal because once a vintage seasons by about 2 years, it experiences positive survivorship bias, whereby the poorer performing borrowers have charge off and the better credit borrowers continue making payments. Thus, eventually, by years 2 and 3, mistakes in underwriting are weeded out, and the true underlying performance of the consumer is on display. We can then see how the underlying consumer is doing by focusing on the performance of the seasoned vintages. This is why we're concerned about the seasoned vintages deteriorating after having shown flat delinquencies already for several quarters. Here again, another exhibit 2 and 3, in this case CarMax. We don't have that, so we can't really focus on those things. But here as well, they are showing us delinquencies suddenly doubling in the past 2 months. though fortunately from a small base. Finishes off by saying here one interesting pushback we've heard today is that vintages are showing worse performance because these vintages are experiencing faster prepayment activity. This actually correlates with the high auto refinancing and debt consolidation volume we've seen recently, with auto refinancing growing around 70% year over year. The idea is that good credits have refinanced away, which leaves borrowers with worse credits. While this makes sense, we don't consider this a positive retort against the data, as it's basically resulting in adverse selection to consumer finance. The broad nature of monthly data deterioration does suggest that these issues are not company specific, but a broad consumer issue. And now, of course, you can now understand when we talk about credit, when we talk about delinquencies, if there is bad data out there, even if SoFi is not mentioned here, but you can link SoFi's business to this, you can understand why there is a negative impact on SoFi stock. Now, fortunately for us, we did have comments from SoFi's management at the start of September during the last analyst conference. They said the following thing. SoFi reported a strong, consistent performance on its credit portfolio, seeing no negative changes in credit trends. This success is attributed to robust consumer demand, driving significant revenue and margin growth. The company highlights its world-class credit models and underwriting, which have proven resilient across diverse economic conditions, including recessions and multiple interest rate cycles. To maximize its market reach without increasing balance sheet risk, SoFi uses its capital-light loan platform to originate loans for partners. This allows them to serve borrowers who fall outside their strict internal credit box. By doing this, SoFi monetizes a large volume of annual loan applicants they would otherwise decline, turning them into revenue and new member relationships without assuming the credit risk. A core focus is helping people refinance high-interest debt, like credit card balances, into more favorable loans. The company's marketing strategy is key to identifying borrowers with the optimal credit profiles. SoFi remains confident in its credit outlook and overall growth due to its disciplined approach, its proven underwriting engine, and the ability to scale originations with stable partners. So, what do we conclude for now? Is that SoFi is just a better business. How do we support this statement as well? Well, this was a tweet today, Tuesday, from SoFi Investors Relations, tweeting to Brad and Chris here, two great follows on X, by the way. They said, as our CEO Anthony Noto said at the Goldman Sachs conference at the start of September, credit is also performing well, and so we've seen no change there, a reflection of our consistently strong underwriting capabilities. And we can see this in last quarter's report, consistent credit performance across the board. Now you're going to say, oh, but look at this uptick right here. This uptick right here has been explained right here. Student loan net charge-off in Q2 included discrete impacts from switching loan servicers and the purchase of a student loan portfolio. Okay, nothing has changed about the quality here of the credit. Also, if we look at the quality of the borrowers, a very, very high FICO score is found, something that you might not find with the Upstart and the rest out there. This is something that was, of course, very important to SoFi, and this is why it doesn't matter if we are seeing tailwinds or headwinds in the economy. SoFi has been quite resilient over the last couple of years. Of course, when there is, let's say, a recession, or if there is a recession, nobody's really safe. But you do want to have the highest quality business, the highest quality model, and the highest quality borrowers in order not to get hit as much as all the rest. And I do think that I trust management enough in order for them to make sure that that is exactly what's going to happen. Plus, looking at the 90-plus day delinquencies, you can see we went from 0.46% to 0.42% here if you look at personal loans. Looking at student loans, that basically remained flat. So again, I'll reiterate, the stock is taking a breather. The stock is getting impacted because of news that is not directly related with SoFi, might be, but for now it is getting impacted because another company in the same industry is showing, according to the data, some weakness. Now, let me ask you a question. Over the past 10 quarters or so, has management been disappointing? Have they been under-promising, under-delivering, or not? I think the answer here is quite simple, right? And quite clear. They have over-delivered. They have over-delivered because they are, in my eyes, overly conservative. Although I do think that they will start to be a bit more aggressive right now when it comes to growth. But if we zoom out, the performance of the stock, of course, now has been incredible. If we zoom out and look at the business has been doing extremely well, every time record quarters. And this is not me saying this is coming from SoFi's own earnings report, right? Last quarter, adjusted net revenue, adjusted EBITDA, fee-based revenue, member growth, product growth, all record quarters, and management raised 2025 guidance. Plus, the current expectations for SoFi, in my opinion, are still well below what SoFi will report, whether it's EPS or revenue growth. But sure, panic away, because after we've gone up almost more than doubled actually, year to date, we are now down 12% in the last couple of days. The horror of seeing a small, healthy pullback in a stock that has gone up non-stop for the last couple of months and last couple of weeks as well. So, yeah, for those that still want to look at Upstart, I'll say this thing again and again. Just look at SoFi. It's just a better company, better management, better execution. You sleep better at night. And so voila, that's about it for me. Will I be buying more of SoFi? Not currently. It's already a very, very big position for me. So I'm not saying, oh, I have to buy. No, if it was a small position for me, then probably yes. So that's about it for me in this video. There you have the quick update. Hopefully most of us are already immune to these silly pullbacks and we don't really freak out and we know exactly what is going on. Anyways, that's all I've got for you right now. See you in the next one. Bye-bye.